Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for September 1st of 2025. Well, happy Labor Day to all of you. I hope everyone is well. It's hard to believe the summer is now in the rearview mirror as we head into fall here. I know a lot of us are cooking out this weekend and probably noticing a little bit of pain at the grocery store. As you can see here, cattle prices have moved up rather dramatically over the last several years and kind of almost in a kind of a vertical motion here over the last year. And reason for this, obviously, is we've had very thin herds. Cattle volumes are very low, and feed prices are extremely high, and so the cost of ranching has gone up certainly over the last several years. And I thought we'd just start with something that is probably on everyone's mind as they're going to the grocery store and buying those steaks to cook out this particular weekend. So as we talk about inflation, certainly food prices are important to us, but also electricity. This is something that's a little bit more salient. You think about how far we've come over the last several years in AI and the need for data centers to help support AI. I think this is clearly one manifestation of it. We've got basically an average electricity price across a lot of different cities in this particular basket, research by BCA down here. You can see really going back to 2021 is when this all really started. You say like 22 in earnest when it kind of eclipsed the prior interim high price, but you can see electricity prices from a basically a cents per kilowatt hour basis have gone up in percentage terms quite a bit lately, and this is one manifestation of the need for power to support data centers and the need to find alternative sources of power to power those data centers. So we talk about the Atlanta Fed a lot. They do a really good job of forecasting our economic growth, and they've really done a great job in particular over the last year. And right now, they're looking for somewhere on the order of about 3.5%. This is by virtue of a composite of a lot of different data that they look at, and that data has clearly given them more confidence and maybe more enthusiasm over the last month or so. As we can see here that estimate is now 3.5, whereas our blue chip consensus of economic forecasters is still actually around 1%. So it'll be interesting. We're going to get the third quarter GDP number probably about the third week of October. Usually comes about 3 weeks after the close of the calendar quarter. So it'll be a little while yet. And obviously what happens this month in September could be quite influential into this estimate, which, obviously can change over time. But right now, despite tariffs, despite this lingering inflation, which we'll talk about in a second, and despite maybe some chinks in the labor market and some, if the prospects of maybe a bit slower economy down the road, we're certainly not seeing it now. In fact, I've been saying that I thought we would get this sluggishness in 2025 and then actually have that be the runway for a better 2026. And if we do have a slowdown, it may not necessarily come in the third quarter, but it may come a little bit thereafter. Here we have a median housing payment data from Charlie Bolello as a percent of median income. So housing affordability is an issue, and you've got 2020, 21, 22 here, and we thought we had that acceleration in home prices, and we were getting data around the 43% level. That's actually 48% now. So housing affordability, if anything, has gotten worse over the last several years, making it very interesting making it a very interesting market. And we're seeing price growth. We'll talk about that. We've seen lenders get a little bit more conservative, perhaps. And you see a lot of builders, kind of go through these rolling funks, if you will. And we've seen some changes clearly in the existing home market. Consumer spending, something that we look at, it's very meaningful, represents a majority of our economy here. You can see, very clearly we've got some of these data points that are going down. Now, electronics seem to be moving the other way. You've got motor vehicles that are in decline, but they're still positive on a year-over-year basis, where you've got a lot of negative components that seem to be tracking a little bit lower on the consumer side, which probably is not surprising. We'll talk about in a second. We've had some rise in goods inflation by virtue of tariffs, of course, and higher prices are probably dampening demand at this point. Here we have credit card delinquencies. This is something that we've monitored for quite some time. This is just yet one additional iteration of this. We've got Bloomberg here on this particular chart. You can see that that's moved higher, and you've got to go back to the global financial crisis to see data in this particular data series. It was as high as it is now. Stock valuations. Let's talk about the stock market. Again, despite all of the tariff rhetoric and everything else, we're at essentially new highs when you look at trailing PE, forward PE, kind of a composite. And you've got the S&P logarithmic scale here, continues to move higher, and these represent basically valuations, a composite valuation. And when you look at obviously 1929 is a very foreboding type of data point here, and you got 1965, and then 1999 before you hit the tech bubble. It's not to say that we're going to have the bubble bursting, but typically when you have these peaks, you have a kind of a retrenchment, if you will, in your percentile rankings of all of these valuation composites here. It typically will go back down at some point, and you'll have a moderation in values. But we do know that this is the S&P 500, and it's not your father's S&P 500. The construction of it is completely different than it was 15, 20 years ago. Much more technology laden. And in fact, if you include, as I've mentioned before, kind of the consumer related components that feel very much like technology, like say Amazon, Microsoft, then you get a lot Google, you get a lot closer to like 45% of the index is in that realm, and you can see why these valuations are extraordinarily high at the moment. One good thing that we have noticed is that breadth in the market has improved, and so this is basically the percent of advancing stocks on the S&P 500, and you can see, generally, when you have a good and a broad market, that number is well above 50, and you can see some of those years in that decade before the pandemic, you had that. And good news here is, while it's not like overly aggressive, like 2022, we had horrible, relatively poor breadth, I should say. We had, but that was a bad year for the market, and so we were led down by Nvidia, which a lot of people forget was down 50% in 2022. But the breadth has seemingly improved a little bit here over the last couple of years, over 50% here. It's not great, but it's not terrible either. Now we look at margin debt on the market. And so essentially this is debt that's incurred by investors that want to basically leverage their investments in the stock market. And obviously they want the stocks that they're buying to go up so they can repay the loan and witness a gain and basically use other people's money to do it. This is also a contrarian signal. When you look at margin debt moving higher, that tends to historically indicate some froth in the market. If you go back to 1997 and the tech bubble, we had a lot lower overall debt, margin debt, just over maybe 0.3 trillion, about $300 billion here. But you can see 05 to 07 that we had this interim peak, and then it went down obviously after we had the market go down, and people had to close those accounts and take losses and have margin calls. It's a very painful process. I don't recommend it. But then, leading up to the pandemic, and then we had this reset in 2022, and then here we are at record levels on margin debt. So, just one of those various cautionary flags, aside from valuation itself, that kind of lets you know, all right, well, there is a little bit of froth in this market here right now. There is a caveat to all this. And this is great research, again, by Charlie Bilello, that shows, if you invest on an all-time high, you shouldn't feel too bad about it if you have a long-term horizon. Even if you have a relatively short-term horizon, this is basically going back to 1989 through essentially July. And if you invested at any time during the stock market, then your 1 year return on average is about 11.8%. If you go 3 years, it's about 39%, and 74% if you go 5 year. And these are cumulative returns, so they're not annualized, of course. But if you invest on an all-time high, there is a propensity for the market to continue to go higher. And I'm not saying that this is my prediction that it will. I do think that there's a lot of liquidity behind the market to help support it at these levels. Although we could see, a correction of some sort easily. We could see a 5%, 7% downturn at any moment with any particular catalyst. But I do want to caveat that, one should not be scared about being invested. Again, it's the whole notion if you're not in the market, then and you're trying to time the market, it could be very challenging for you because you actually generate better returns if you're in the market and you put money in at a new all-time high. You can see here in the 3 year and the 5 year. In every instance here, you've had really good returns despite the fact that you're investing on a high of the market. Here we have a quick look of the market going back to 1949. I've shown this chart before, and it's just to highlight that basically you're in a bull market a lot more often than you're in a bear market down here. And so the key takeaway here is that your bull market average is about 5.3 years. And again, that's not without resets. I mean, on average, you have a 10% correction every 3 years or so. And you have 5% corrections, several times within a year on average. But if you're dedicated, diligent, and you're not emotional, and you just let your stocks ride, then typically you're going to have a pretty good return, and it's going to last a while. Now, the bear market average is only about 12 months long, and it can feel painful because the downside can be visceral in any one particular year. But again, over the long term, strong bias upward. Here's another depiction of that here in this histogram chart, basically showing you that the average annualized total return going back all the way to 1928 is about 10% in your S&P 500. And you're going to be positive about 3/4 of the time. And again, in some years you're going to be quite positive. And then, again, if you have a long-term horizon and you have, like, say, a 2022, which actually falls into this bucket here, from maybe a blended return. But at one point in 2022, we were down over 20%. But if you talk about this area here, it feels really painful in the moment. But just know that if you're diligent, again, those long-term returns are much more agreeable if you can be patient and non-emotional. Here we have future positions. This is basically the percentage of net shorts in the market, and you can see here that that there's a lot of skepticism out there and people making hedged bets here on the market direction. It's still quite negative. Maybe not as negative as it was back in 2022, 23, but still we have a lot of short positions in the market that, ironically, as the market keeps going up, people are having to close those positions, and in some respects, it's helping to fuel the rally. So here we have something I found was really, really interesting. So, we talked a lot about, back in the day, we had quantitative easing and how that was the reason for the melt up in the market, that we had all this easy money out there and it was sloshing around and people were using it and trying to find a home with it and investing, putting it into the market. That made total sense. But what we have here is that the Federal Reserve's total asset level, despite the fact that money supply is reaccelerating, and we'll see that in a second, but their total assets have gone down 22% going back to basically 32 months ago. However, the stock market has gone up during that time. So this is really kind of a decoupling of this theory that you got to have easy credit, you got to have the Federal Reserve has got to do quantitative easing for you to get this kind of market juice. The data says that it's just not true. Here we have a chart going back 1990 on Fed funds rate and then expectations. Looking ahead here, I think it's clear that the market is very much expecting at least 25 basis points or a quarter point cut here at the September meeting and looking for additional cuts thereafter. As we'll see, it's a very, very tough environment for the Fed because they have a dual mandate of stable labor markets and also stable prices. And they're trying to achieve that delicate balance of the neutral rate that will support non-acceleration of inflation as well as basically full employment. And so the expectation is that these rates are going down. You can see we've already made a couple of steps towards that, and you can see the rapid rise in rates that we had to endure several years ago to fight this inflation. But what's interesting here, and this is from BCA research, is that the Fed typically starts to cut rates actually before recessions. And again, no one's predicting a recession right now, but typically when you have a Fed that's cutting rates, it's in advance of that. And even here, Fed was starting to cut rates before the pandemic, and that little tiny sliver here is actually not a graphical error, but that recession was so short that it barely even registers. But again, very interesting. We're not predicting a recession here. Inflation's sticky. Fed's in a really tight spot, but yet the market's still expecting a lot of declines. If we don't get these declines, then you're going to see a lot of market upheaval. So here we have a little bit more of a kind of an analytical look at this. So we've got expectations for the Fed funds rate. Here we are in August 25 as we transition, all the way to January 27. You can see that the market is expecting a continuous decline in interest rates, which, arguably, if you politicize the Fed, I mean, you could very well have this. I think the law of unintended consequences, though, is if you have, an easing of credit at a time where you have sticky prices, that could lead to another resurgence in inflation. And as clearly we look at, this represents kind of the bulk of the current presidential cycle. I'd say December 26 is a very long way away, relatively speaking. And we'll just have to see if we're going to get there at the end of this year, essentially looking at a full 50 basis points of rate declines. Again, we'll see. I think the market's probably going to get 25 basis points in a month, and we'll just have to see if they come back by December and bring that down again further. Very interesting development in the last FOMC meeting is that for the first time in a while, we had two dissenters, and that's depicted here. Now, this is kind of going back to 1980, when obviously we had a lot of inflation back in 1980. Paul Volcker had come into the chair, and he raised rates to fight that hyperinflation. You can see that there's a lot more discord, a lot more a lack of unanimity, relative lack of unanimity here in voting. But that died down. You go back to 2007, everybody was in lockstep. You got to go all the way to 2024 before there was any kind of a dissent, following the global financial crisis here. And even then, it was only one person. But then we had Fed Governors Waller and Bowman that dissented in this last meeting. And again, we are likely, I just say that there's a reasonable chance that Fed Governor Cook is fighting her termination by the Trump administration. But if that person is replaced by a Trump appointee, then you'll see more dissent to the extent that Fed Chairman Powell is resisting rate cuts. So this is also from the Atlanta Fed, but this is business inflation unit costs. And so this is what businesses are feeling. Now, we did see a bit of a pickup, 25, that's down to about 2.3%. There are tariff impacts out there. We're just not seeing it in this particular data set. But these levels are obviously higher than basically the trough of the decline that we saw. So, but clearly off their interim peaks, and I think it'll be interesting to see if this begins to trend back up now that we have kind of more certainty with regard to how these tariffs are going to play out. Core PCE inflation rates, we've been following this obviously very closely. This is the core personal consumption expenditures inflation rate year over year. This is going back to 2022 when we know that inflation was a lot higher. Again, a very methodical downtick in inflation, and then very stubbornly in place during the bulk of last year and into this year. And just here in May, you can see, 2.7, we reattained that and we've kind of inched up here. And I think this is the earliest manifestations of the tariffs that are in place now. As we'll see, there's a bit of a divergence between goods inflation and service inflation. Here we have some consumer sentiment, and it's important to look at consumer sentiment index. And again, this is a soft data point. This is not like orders or shipments. This is basically sentiment. And it's much more important ultimately what consumers do rather than what they say. And sentiment is still subdued here. And from the consumer perspective, the long-term inflation rate, they're looking at somewhere around 3.5%. And of course, this is filtering a lot of the tariff rhetoric that still remains out there. And you can see that that's well above, in relative terms, where we were for quite some time. But it is down from its peak. But just the takeaway here is you've got consumers that are still driving the boat, still moving the economy forward, but sentiment is low and their inflation expectations are elevated. So I did mention this a couple minutes ago. We've got goods inflation that is represented in this dark line here, which obviously spiked when we had all of the supply chain issues, cost input issues. That's come down, actually went negative. We're very excited at that, but then the implementation of tariffs, that's moving higher again. Service sector inflation did peak, and it did kind of start around the same time, but not with the same amplitude of goods inflation. But that had been coming down, and we see that beginning to kind of trough out here, and I'm not sure if that's going to move higher. The overall trend here is nice. But it's still elevated. It's still, 4%, if you will, year over year. Whereas I think the key thing here on the goods side, which is where these tariffs are impacting, right? The tariffs aren't on services necessarily as much as they are an impact of goods inflation, and we clearly see that moving higher. Here we have inflation pressures within the service sector, and we showed this same chart a couple months ago. You can see here in the green line, this represents the Institute for Supply Management Services Prices Paid Index. And what's interesting about this data series is oftentimes you see this data series overlaid with the Consumer Price Index, which is in this darker line. But they forward it, they lead it by 3 months, and so this is in fact a leading indicator for CPI, with the presumption that you're going to have these prices paid by the producer passed along to the consumer, i.e., Consumer Price Index. And so, this is telling us that we should be on point to see some increase in consumer inflation over the coming months. This is a hypothetical from Torsten Slok at Apollo. I thought it's a very interesting overlay because of the correlation. So, basically this blue line represents what we saw in year over year inflation going back to 1966 here, and then, the 1974, 1976, and then the inflation did come down during the Ford administration, but then it went right back up. And then here's Reagan gets elected. As I mentioned a few slides ago, Paul Volcker jumped into the Fed chairman's seat and raised interest rates considerably to fight this. And then ever since then, we've had this kind of this secular decline in inflation up until just a few years ago. And this also led to a decline in bond rates, which is very good for bondholders. But now the green is the CPI as it exists today. And so you can see these overlays. So this is 2014 and the green line, 1966 in the blue line. And look at this relationship. I thought this was very uncanny. And so, you know, Apollo's not making the case that we're going to have the second inflation mountain. The inflation is going to go back up, but it could, right? I mean, the feedstock is there with this tariff regime. And again, I think it's tough to kind of label tariffs as like a catalyst for inflation because for long-term inflation, because tariffs are really a one-shot deal. I mean, you get a reset in prices with tariffs, and your prices go up once, but they don't keep going up. And so, when you talk about inflation, inflation is defined as a rate of change year over year. And so if you have a one-time shock, like prices go up, but then they stay there, then, then eventually that rate of change is very nil, right? But your inflation level is higher than it was. And so again, this is what happened back in the late 70s and into 80 before you had to really fight inflation by raising rates. No one's expecting that now, but again, a very interesting overlay. Consumer sentiment is a funny thing, and we talked about it, and we know consumer sentiment is a little bit subdued, but we can see here that it's really anchored in the lower income cohorts. If your income is over $100,000, your sentiment is actually going up. You're feeling better about things, and I think that's a very interesting development. So just to show that, when you dig into, you peel the layers of the onion back and you delve into the socioeconomic layers, that not everybody is feeling the love here. And you've got upper income folks that are really kind of probably in some respects tone deaf to what's going down here. And these are the people that are supporting your consumption right now. We talked a lot about the dollar being weak this year. We did have one year, July, the dollar was up for the month about 3%. It's now down, so we're basically still around, negative 10% or so in the dollar for the year. And again, think about the ramifications of that. And that makes a weaker dollar, from a foreign buyer's perspective, would certainly, on its face, without any tariff friction, make dollar exports or imports to them from the U.S. cheaper. But it also impacts the commodity basket, which largely is priced in dollars. And there are other clear impacts and interrelationships between sovereign rates of interest and inflation and things like that. But dollar is weak, and I would say probably out to remain weak for a while. This is something else that I thought was very interesting. So when you look at all of these different rates, I mean, you've got the investment grade bond yield, you have the earnings yield, which is the inverse of price to earnings. It's earnings over price. So this is what they're earning divided by the price. And then you got your 3-month treasury yield. And then you have like basically real estate investment trusts, which are REITs. They're implied cap rates. So that's a term used in the real estate industry as a valuation metric for commercial properties mostly. And you can see that they're all converging in this 4 to 6 range. And if you go back, to the beginning of this century at least, Yeah, you can see that that convergence is very rare. Something else that is very striking, if you felt like the economy was going to go into a funk, where they were going to slow down, we're going to have an economic downturn, and so on and so forth, you would not see this slide depicted the way it is. Basically, you've got over half, you've got 54% of the outstanding high yield bonds that are trading inside of 200 basis points, 2 percentage points of the risk-free rate, which is a U.S. Treasury. And if you felt like, and again, if you look at these, other percentages, I mean, there's a very small, call it 18% of the market that's trading at what I would consider to be much more normalized spreads if you felt like the economy was going into a recession. But clearly, what this is indicating here is that really nobody from a high yield bond perspective is remotely concerned with the economy right now. Okay, here we have the 30-year Treasury yield. You can see that that is kind of flatlined us, uh, and it continues to, you know, meander kind of sideways in a trading band. This is actually the TYX, so this is more of an index than it is an interest rate level. But you can proxy this and say that this more like 4.9 percentage points. Here we have the spread between the 10 and the 30-year bonds. So you've got that spread beginning to widen out. It is a positive spread, so we have an upwardly sloping yield curve, but this is more of a function of what's happening to the 10-year than, as literally we just saw, than what's happening at the 30-year level. So this is what the market is pricing, and by virtue of the 1-year inflation swap rate. And so market pricing is about 3.3%, as indicated up here in the headline. So, this is what's really interesting. The Fed's inflation target is 2%. And so if the market pricing is indicated by the swap rate, so this is a very good indicator of what the market truly thinks that inflation level is gonna look like. But if that level is 3.5%, why on earth would the Fed be reducing rates when that level is so far above its inflation target? And that is the big conundrum that we face now. And of course, the Trump administration is not really they're not dialed into this metric. And again, if you politicize the Fed, then I'd say all these natural relationships probably go out the window, and you have lower rates just because you want them, and it helps you in a reelection scenario. But again, it's unusual to have inflation expectations so high above a Fed inflation target, and then also be entertaining the notion of an easing cycle by the Fed. Another interesting development, quite a few of those in the basket this week, but foreign demand in U.S. assets in May and June really rebounded. And you look, here's kind of these bars represent different months. And so if you look at April, May here, and even June, you can see that these are pretty well represented. You got Treasury notes jumped. Certainly got equities. In fact, European ownership of equities is actually outpacing European ownership of European equities. They own more U.S. equities and they own of their own issues. Not so much in corporate bonds, maybe a little bit more in government agencies, which is kind of viewed as more of a riskless proxy in some cases. But clearly, after April, there was a brief moment there in time where, we all felt like there was going to be this huge outflow of foreign investment out of the U.S. because of all the tariff tantrum, if you will. But honestly, that just hasn't happened. In fact, it's continuing to move the opposite way. Here we have money supply. I was very excited when we got to this point a couple of years ago when money supply was decelerating. So this is actually an aggregate number. So now we're talking about money supply as defined by the M2 measurement. is over $22 trillion. But you can see here that it's kind of fish hooked and it's moving back higher again. And again, if you look at inflation drivers, money supply is a big one that is very often not discussed in the media. And I think this is an important point. So, for the folks out there that are advocating for these rate decreases, I'd be wary because money supply tends to fuel inflation over time. Well, as you can see here on this slide, in data that goes back 20 years, basically, what the aggregate levels of some of these items are. So we just talked about inflation and money supply. Money supply seems to be moving back up. Cumulatively in the last 20 years, money supply is up 240% almost. National debt is up 365%. Our national debt has absolutely exploded, and so all of these, add to, basically they basically goose growth. I mean, you're putting more money into the economy. It's obviously going to have an impact on growth, but it's also going to help support at least a baseline level of inflation, which you can see your CPI is up 66%. And so obviously in 20 years time, the aggregate jumps here haven't manifested in an equal jump in inflation, but it is notable. In fact, we've had relatively low inflation for basically the last 15, 20 years relative to the last 50 years. But this sets the stage for continuous future inflation. Well, and continuing on this theme of very interesting developments that I would not have expected, this is clearly one of them. You've got in this yellow line here, you've got gold holdings as a percent of foreign reserves by central banks. You can see that they've increased their levels of gold holdings, and obviously some of this is influenced by the price of gold, which has gone up dramatically. But for the first time since 1996, you see that foreign central banks hold more gold than they do U.S. treasuries. And again, you've got to go way back here to see this. And so, 1980 represented basically the 80s in general represented a cataclysmic change in the central bank reserve policies. And so we created this regime basically about 20 or about 30 years ago that that they were holding more U.S. treasuries and helped to support and fund our deficits. But lately that has clearly changed, and I think this is giving gold a lot of staying power and should help to support the price of gold for quite some time. That's all we've got this week. I hope you've enjoyed the chart pack. Have a super week and a great start to your September, and we'll talk to you again soon.